If you are a tech industry worker about to start a new job, you might have a choice in how you get taxed. You might be able to choose between being a W-2 employee or a 1099 employee. The decision that you make could significantly impact how much you pay in overall taxes. As a software engineer, I've been paid both as a W-2 employee at times and other times as a 1099. So let's go over some of the basic differences. W-2 employees are often referred to as payrolled employees. This usually happens because the job is intended to be a long-term arrangement with the company. However, it doesn't necessarily mean that you have any additional job security. Nobody's really permanently employed because the company can still fire you at any time. The real reason W-2 employment tends to be attractive is because such jobs often come with a benefits package, with the main benefit being health insurance. In the United States, we have to pay for our own health insurance because we have a private system, and health insurance premiums can be very expensive. There are other perks that you might get, such as a 401k match, and I'll go over some of those in a moment. W-2 jobs also tend to be salaried positions, but that's not always the case. Some W-2 jobs are paid by the hour, and some W-2 jobs have no benefits package at all. Now, a person working for a company under a 1099 arrangement is typically referred to as an independent contractor. 1099s usually have a more loose and non-committal employment relationship. These employees are treated as if they're running their own business, and they're technically not really employees at a company. In the past, I've worked full-time jobs as a 1099 employee. You might end up in an arrangement like this if you are a contract-to-hire type of employee, or maybe you have a temporary arrangement with the company where the employment is uncertain after a future date. And sometimes you could tell them, just tax me like a 1099 employee because I don't want to be a W-2 employee, and many companies will gladly do that for you. The non-committal perception of being a 1099 employee might even be useful in certain situations. For example, if you're negotiating a job with an employer and they have some uncertainty about hiring you and the formality of it, 1099 could be an option that you throw out there that would be less committal than W-2 because they won't have to onboard you into their benefits package. 1099s are also what you receive if you do any sort of gig work. For example, Uber drivers, Etsy sellers, and YouTubers have their earnings reported to the IRS under the 1099. This is because from a tax perspective, we're all considered to be running independent shops and businesses that just have their businesses facilitated by those big tech firms. And for anybody who's wondering where these funny names get derived, W-2 or 1099, it's actually the name of the form that's mailed to you at the beginning of the year. And in this part of the video right now, I'm actually going to walk through a tax return to show you the differences on a mathematical level between the W-2 and the 1099. Here's a spreadsheet I made where we could do a calculation of what you would be making as a W-2 employee and figure out what your tax would be given certain assumptions. And then we could compare it against being a 1099 employee. The first thing I want to note is that when most people talk about how much money they make, they're talking about their base pay when they throw out a figure, because usually the benefits package is difficult to calculate, and a lot of people don't really think about that as being part of their compensation, even though it is a very important part of their compensation, especially when it comes to tax. One example of a benefit program is that some companies give a little extra cash to employees who want to spend money on certain purchases like related to fitness or health related like that. In our hypothetical example right here, let's just say that this company is generous and they give $100 a month or $1,200 a year in wellness benefits. A cash benefit like this is actually taxable as if it were part of your regular base pay. Another example of taxable compensation would be whatever bonus that you get in the year. Let's say that this company gave the employee a $1,200 bonus. Some companies give very big bonuses where a bonus is a significant part of the compensation. All of that is taxable as regular income. Now let's talk about the employer health insurance benefit. It's quite common for it to cost over $10,000. Let's just say in this example it's about $12,000. Depending on the state you live in, it may be more or less than that. This is a big part of compensation, and a lot of people in the United States get stuck in a job at a company that they're not really thrilled about, but they're staying there mainly because of the health insurance coverage that they get. Next, let's talk about health savings accounts, also known as HSAs. HSAs are tax advantage accounts for your healthcare expenses. The money you put into an HSA is exempt from income tax, and that money is also not taxed when you withdraw it for healthcare related expenses. Some companies will make a contribution to your HSA account as part of your compensation. In this example, let's just say it's $200 a month or $2,400 per year. And finally, another common type of compensation is the 401k match. That's based on the amount that the employee elects to contribute to their 401k. In this hypothetical case, let's say that the employer has a 401k match of up to 4%, which is fairly typical. So we'll take 4% of the base pay. And in order for this employee to get that 4% benefit, they would have to contribute 4% of their income to the 401k plan, which would be $4,400 in this case. So this employee is putting away $4,400 into the 401k, which is deducted from their income tax, but the company is throwing in an additional $4,400 as part of their 401k match program. Another type of compensation that you see frequently in the tech industry are incentive stock options. In this hypothetical example that I'm doing, I just want to focus on the tax. When you're dealing with stock options, there's a lot of future risk and uncertainty involved, and that makes it very difficult to compare a benefits package, including stock options, versus being paid just in cash as a 1099. So in this example, we're just going to assume that this employee has choices that are all cash between two different types of offers. In our hypothetical W-2 employee example here, let's see what this employee is actually making. This person might say, oh, I make $110,000 a year, but when you factor in the benefits, it's actually quite a bit more than that, because there's $21,000 worth of value in the benefits package, and that's a significant part of compensation. So this employee with a benefits package like this is actually making about $131,000 per year in salary. So if you're comparing two job offers that are salaried and W-2, always factor in what the value of the benefits package is. Now I'm going to talk about the Social Security and Medicare taxes, also known as FICA tax, which stands for the Federal Insurance Contributions Act. This takes a chunk out of your paycheck, and most people don't even know about it. The government takes 7.62% of every dollar that you earn, and they give it to the baby boomers in the form of Social Security and Medicare transfer payments. Now, a lot of boomers will probably tell you that they paid into this system during the years that they were working, but that's not exactly true. They just paid off the old people of their generation, and now it's the millennials and Gen Z who are paying for the baby boomer Social Security and Medicare when they're working and they're earning paychecks. But don't worry, because some of your income is exempt from FICA taxes. Things that are related to healthcare and that 401k match. Let's go back to our spreadsheet here and look at what the FICA taxes are. We can deduct money that's put into your HSA, both the amount that the employer is contributing and any amount that the employee is contributing. So in this case, let's assume that the employer's doing their $2,400 per year, and then the employee is adding an additional $5,900 from their base pay, and they're writing that off as an HSA contribution. That gets exempt from the FICA tax. The employer subsidized part of the health insurance benefit, and any amount that the employee pays to the health insurance plan is also deducted. And then we also have that $4,400 401k match there. So when you make those deductions, the actual amount that the FICA tax are applied to is $104,000. And there's also a maximum that they could apply the FICA to, which is $160,200, and that's based on 2023 tax year numbers. So money that the employee made that was above this amount is not subject to FICA tax. So we'll take 6.2% for Social Security, we'll take 1.45% for Medicare, and then we'll get $7,956. Something that you don't really see here on the spreadsheet is that the employer is actually paying more than that on their side. It's really weird that this amount is just actually reported as like what the employee is paying, and that's what you could see on your pay stub, but the employer on their accounting is actually paying this same amount as well. So it's actually getting paid twice. So this employee who's making a gross income, when you include all the benefits, if they're making $131,000, they're actually costing the company $139,000 when you factor in the additional FICA taxes that the employer is paying on their side. Now I want to bring up a real-world pay stub to show you an example of how the FICA taxes are calculated and how the deductions appear. So here on the right is a pay stub, and here on the left is a spreadsheet where I'm highlighting how this calculation is made. First, I want to point out this pay amount here, which is the base pay. It corresponds to this. And if we multiply this by 24 pay periods, which would be 2 pay periods per month, we come to a salary of $95,000. If you notice, this company calculates in this pay period 86.67 hours. 86.67 hours times 24 pay periods equals 2,080 hours. That's how many working hours you have in a standard work week of 40 hours times 52 weeks in the year. 2080. Now I want to bring your attention to this box over here. These are deductions of what the employee is paying that gets excluded from FICA tax. Here we've got our medical insurance payment, corresponds to that $200 there. We have $150 going to the HSA. We have $27 in dental insurance. And then for the vision plan, $6.27. So these 4 items here are medical related, and they get deducted from FICA tax. Note that the 401k here is not deducted from FICA tax. So that amount that the employee is putting into their 401k still applies to the FICA tax calculation. So if you subtract these 4 items here from the base pay, you get $3,575. The FICA tax will be applied to that. So 1.45% times this amount gives you your Medicare tax. 6.2% times this amount gives you $221.65. And where do we see those numbers? Here, Social Security, $221.65. And then your Medicare is a $51.84, which I've got right there. And down here in this part of the pay stub, we've got these employer payments, and these are those things that I've calculated as part of the total compensation package, but they're not really counted as part of the employee's regular pay. This 401k match, this amount here is what the employer is paying for this employee's health insurance, as well as like the dental. There's a life insurance benefit thrown in there. There's a vision benefit thrown in there. This is the HSA match. These types of line items that would be part of the overall compensation package, but not subject to any sort of FICA tax or regular income tax. I reflect that on my spreadsheet by deducting from the gross earnings anything health insurance related and the 401k match. Now, moving down the spreadsheet, we could calculate our federal income tax. The amount that the employee contributes to the 401k is taxed for Social Security under the FICA tax, but we can deduct it for the federal income tax. So I have it here as the 401k deduction. And if you're participating in a 401k plan, you're likely going to be disqualified from being able to make a tax-deductible IRA contribution. So I'm having this 0 right here. And these other deductions I have listed on this spreadsheet are related to 1099 employees. You don't get these if you're a W-2 employee. I'm going to circle back and talk about these later. But notice that if you're a W-2 employee, you don't get very many options to deduct things for federal tax purposes. So after those regular deductions, we arrive at our adjusted gross income. And here's where the adjusted gross income appears on the 1040 tax return. Next, we're going to determine our standard deduction. You can itemize deductions using Schedule A or use the standard deduction. If you're a W-2 employee, there's 2 main ways that you could take additional deductions on your federal income tax. You could itemize your deductions using Schedule A, but that's a really complex form with very many rules around what you could deduct. And most people find it very difficult to use and don't have situations that apply to the deductions on Schedule A. So most people are just likely going to take the standard deduction. And the standard deduction changes depending on your filing status. Whether you're a single person, a married person, you could be married and file separately, but that's actually a little bit worse off than being single because there are other credits that you may not apply for. Or you could be a filing status called head of household, which means that you're not married, but you have a dependent that you're taking care of in your house, like a kid. And for taxes, the treatment that you get as head of household is in between being married, filing jointly, and being single. Alright, so let's take another look at our 2023 1040 form. And here it tells you what the standard deduction is. If you're single or married filing separately, the standard deduction is $13,850. If you're married filing jointly or a widower, you get $27,700. And if you're a head of household, it's $20,800. Now, going back to my spreadsheet here, I'm going to calculate the tax under all three scenarios. Here are our standard deductions. So what these three cells here are is your adjusted gross income. You take away the standard deduction amount, and this is the amount that you're going to be taxed on. If you thought that you paid enough taxes, 7.65% of FICA tax taken out of our pay stub, it's actually more than that, 15.3 when you consider the employer side of the accounting equation. You're wrong, because now we're going to pay the federal income tax. Going back to our 1040 example here, we have our $99,600 in gross income, and we put here on the standard deduction line $13,850. I'm assuming that in this example we're single, but it would be different if you're a different filing status. And here $85,750 is our taxable income, just as it shows on the spreadsheet. Your federal income tax is calculated on the next page, the top line here, tax. Now, to figure out what your income tax is, the really simple explanation is that you go to the 1040 instructions and you look up what you owe in the tax tables based on your income on this line right here, the taxable income line 15. So we have $85,750 there. The IRS provides these tax tables, and what you do is you look up in the appropriate column how much tax you owe. So line 15, we were $85,750, and we're a single status. We're going to look at these two numbers here as a reference to figure out where we belong in the table. So it'll be above whatever this is, or 85,750, but less than this number on the right here. So we're going to go down here, 85,750. According to this tax table, we owe the government for our single filing status $14,178. Now let's go to my spreadsheet and we'll see if that's what I calculated out to be. Nope, I was actually off a little bit. I got 14,173. It's just a small rounding error. And the reason is because I used a more precise calculation. I actually have this cell here referencing the progressive tax system down here. And let me explain what this calculation is doing. So here are the federal income tax rates in brackets for 2023. And the way that tax is calculated is, imagine you take every dollar bill that you made during the year and you put it in a giant stack. Let's say, for example, you stack all of your money in dollar bills and this stack of Post-it notes, let's say they represent dollar bills. The government, they'll first look at the bottom part of your stack, and they're going to say, we're going to tax this amount at 10%. So they'll take their 10% tax. Then they'll go up to the next part of your stack of dollar bills, and then they're going to say, we're going to tax this at 12%. So they take 12% of this money. They go up to the next part of the stack. Uncle Sam takes 22% of this part of your money stack. And then for the top part of your stack, which is the last part, the government will take 24% of this stack. Now, this topmost part of tax, whatever the tax rate was on this, whether it's 22%, 24%, or maybe more, maybe it's 35%, that's your tax bracket. So when somebody asks you what your tax bracket is, they're probably asking you what is your highest, most level of tax that you get in this stack. So here's your stack of money now after the taxes have been taken out. It's a little bit thinner, but that's okay because all these taxes that they've collected are going to be used for very important services like the NSA, securing the border, Zelensky. Here's a look at the progressive tax brackets for 2023. Note the difference in the cutoffs for single, married, and head of household. Now let's circle back to the spreadsheet. I have my federal tax calculated for single, head of household, married filing jointly. And now a big part of tax reduction is the child tax credit. That's meaningful to a lot of people. The child tax credit gives you $2,000 off of your taxes per kid. That directly deducts this federal income tax amount. So you have deductions that lower your taxable income, in other words, the amount that your taxes are calculated on, and you also have credits, which are dollar for dollar reductions in the amount of tax that you owe. And certain types of credit could actually give kind of a negative balance on your tax, such as the earned income credit, where people who actually already don't owe tax could get money back from the government. In this spreadsheet, I set the number of kids to 0 for each filing status, even though that doesn't make sense because you're likely going to have a kid if you're in the head of household status, so this is often going to be at least 1. However, I want to compare these based on just the amount of federal tax, and I don't want to take the credits into account, so that's why I have that set at 0. Now, on these bottom lines here, I have what your federal income tax is plus the FICA, and these percentages are like the overall percentages that you're paying in tax of your entire income. And then on this bottom area here, we have the net earnings, which is what you're actually making. So I'm taking this figure up here in G13, which is the gross earnings, including the benefits that you're getting from your employer, subtracting all the taxes, the FICA and the federal income tax, and seeing how much you're actually getting in economic value from your employer. Now, as you can see, being single is the worst filing status to be because you're taxed the highest if you're single. Head of household's a little bit better, and being married filing jointly is the best filing status because you get the best standard deduction. But let's throw in some kids there. If we add kids here to the head of household or the married filing jointly status, you'd see that even more dramatically lowers the tax versus what the single filing status is. If you're single filing status, you're going to have 0 child tax credits because you won't have a dependent. If you did have a dependent, you would be the head of household filing status. Now we're going to do this whole thing again, but instead of looking at the W-2 employee, we're going to do a tax analysis for the 1099 contractor, and we'll see what additional benefits we get, how the taxes in general are structured differently. Okay, now we're back to my spreadsheet, and now I have a column here for the 1099 employee, and we're going to compare it side by side with the W-2 employee. Notice how I'm starting off the 1099 employee with a base pay of $131,200 to compare this employee directly with the W-2 employee who's making $110,000. The reason I have this higher number starting as the base pay is because 1099 employees typically don't receive any additional benefits from the company. They're not going to get like the wellness package bonus. There's no 401k match. This is very important. Anytime that you're negotiating a compensation package for a 1099 job, you want to make the figure higher to account for the lack of benefits that you would be getting in a W-2 job. Moving down the spreadsheet now, we go to our FICA earnings, and this is the amount that the FICA taxes will be applied to for Social Security and Medicare. Notice how if you're the 1099 employee, you don't get the FICA deductions for things like the HSA or anything related to health insurance or 401k, and that's because you don't get those benefits as a 1099 employee. Now, if you notice the amount that I have here for earnings applicable to FICA, it's less than the amount of gross earnings. And that's because there's an adjustment to be made. And let me show you where that originates on Schedule SE. If you're a 1099 employee, it's going to be reported on your tax return a different way than W-2 income. You're going to first start out with a form called Schedule C. On this form, I'm assuming that we don't have any expenses. I'll get into this later, but just for this base case, we're not going to have any business-related expenses. This figure here of your income from your business ends up here on the self-employment tax form, Schedule SE. One of the lines here on line 4C, you have to multiply by 92.35% your 1099 income. 9235 sounds like a really weird number to give you a deduction off of, but they actually derive it from somewhere. It's if you take 100% and then you subtract 6.2% for Social Security and then 1.45% for Medicare, you get 9235. So this is intended to compensate you for the fact that as a 1099 worker, you're paying for the amount of tax that the employer would be paying on their end for FICA taxes. It's kind of a weird way that they do it because it doesn't completely offset everything. It just offsets a portion of things. Doesn't make any sense to me, but that's the math. And I have that math incorporated in my spreadsheet here in an if statement, where if I'm working here on this line, this is set to yes for 1099. If it sees a yes there, then it will apply that 0.9235% adjustment to the FICA tax earnings. So that's what this adjustment is about. Another important thing to note is that on line 7 here, it lists the maximum amount of income that's applicable to FICA, which is for 2023, $160,200. And I have that in my formula as well. Okay, now let's take a look at the rest of Schedule SE. If you have W-2 income, you would put it here and then it would subtract from this $160,000. But we're assuming that the 1099 was our only source of income while we were working that year. But if you do have like a side hustle, if your 1099 is from Uber driving and you do that on the side, then you would have a figure here in 8A because you have your day job paying you as W-2 and then your side hustle income would be listed here on Schedule SE. Here on lines number 10 and 11, notice the figures 12.4% is double 6.2% for the Social Security tax and 2.9% is double 1.45% for Medicare tax. So these are those respective taxes, 15024, 3514, and you get a total of 18,538. That's the total FICA tax number that I have right here. So notice that because on lines 10, 11, we're multiplying by 12.4 and 2.9, it's not what the multiplication was on your pay stub for a W-2. Instead, we're doing double that amount. And that really shows up here on the total amount of FICA tax that you owe. In this case, it's $18,538 versus if you were W-2 making the same income, $7,956. You're paying a lot more in Social Security tax. And technically, that still gets paid anyway. It's just an accounting trick of whether the employer is paying for it or whether you're paying for it. But when you're running your own business and you have a 1099, you're both the employee and the employer, so you pay the whole 15.3%. Now, I know it sucks to pay more in FICA taxes if you're a 1099 employee, but there is a silver lining if being a 1099 employee is your primary source of income. And that's because many of the same deductions that are available to the W-2 employee from their income are also applicable to the 1099 employee, just not before the FICA tax. You could deduct them later in your tax return by Schedule 1. So here's a look at Form Schedule 1. It's actually split into two parts. There's the part where you report your income on page 1, which is up here. As you can see, the business income is reported on line 3. And there's other types of income that get reported here on Schedule 1 as well. But what I want to show you right now are the adjustments to income, which are those deductions that the W-2 employees get pre-FICA, but here you could take them after the FICA taxes are applied. You have the health savings account deduction. You could deduct half of the self-employment tax that we are paying on Schedule SE. Notice this figure 9269 is also the 9269 that we get on line 13 of Schedule SE. And then here we have the self-employed health insurance deduction. So this $14,500 is what my estimate is of a healthcare plan, and I base that on the numbers I also used for the W-2 example. And over here for 2024, you could deduct $7,000 for an IRA deduction, traditional IRA, not a Roth IRA. So you add those up, we get $39,069. And let's take a look at where these pop up on the 1040 form. So on 1040, your Schedule 1 income is reported on line 8, which is our business income of $131,200. And then we have those deductions, the adjustments to income reported here on line 10. Let's have a look at my spreadsheet here for the 1099 employee. We'll scroll down a little bit. We don't have a 401k deduction, but we do have an IRA deduction. $7,000 I have it listed there. We have our HSA contribution of $8,300, half of the self-employment tax that we paid. Now notice that it just partially offsets the self-employment tax, not the whole thing. You're not getting rid of the entire half. You're just deducting it from the amount that you would be paying federal tax on. It's kind of a proportional calculation, but it's not a dollar for dollar offset. However, it does help. And then I have our health insurance deduction, which is a combination of these two figures up here, the employer amount that they paid, which is $12,000, and then the employee's contribution, employee health insurance costs. Well, it's actually these two figures put together. All those add up to $39069. Another significant tax deduction you get if you're a 1099 employee or a business owner is called the qualified business income deduction. It started in 2017 actually, when Congress passed a reform package called the Tax Cuts and Jobs Act. And the qualified business income deduction of this bill allows you to deduct 20% of your business income. Here I've got the qualified business income deduction noted on my spreadsheet for 20%. And here's what it looks like on the 1040 form. We have it here on line 13. And notice that in this example, I'm using the standard deduction for a single person. And we come to our taxable income of $53,895. This qualified business income deduction helps out 1099 employees quite a bit. Back to the spreadsheet, here's taxable income. Now we could actually get to the good stuff and do the comparison of this 1099 employee situation versus W-2. And what do we find as far as what this person's take-home pay would be? Notice that because the 1099 employee has more deductions that can be leveraged, that ends up with a lower federal income tax bill versus the W-2 employee. But that gets offset by the higher FICA tax. In the end, if we look at what the federal income tax is plus the FICA tax, as a 1099 employee, dollar for dollar, you're paying more in tax across different filing statuses too. And here on these bottom rows, I have the comparisons of what the net earnings would be, your take-home pay after paying your federal taxes and FICA taxes. So for a single person making this type of package, which is worth $131,000 in economic value, that person would be having a take-home pay of $109,000. Now remember that $131,000 includes health insurance and other retirement-related stuff, things that won't be immediately felt in paying your rent and bills. But that person gets to take home $109,000. They're the head of household. I'm not having any kids noted on this because I don't want to have the child tax credit factored in. So we're just assuming that this is even without the child tax credit, because with the child tax credit, it'll be even lower for head of household and possibly married filing jointly. But without that, it would be $112,207 versus the 1099 employee under the same circumstances taking home $107,000. So there's like a $4,000 to $7,000 difference depending on what the filing status is for this individual. And this is why it's very important to be aware of your tax filing status. You could be losing money to taxes if you don't compensate for that in your negotiations. A lot of employers, if you want to be 1099, you tell them that you want more money on an hourly basis to compensate for the additional taxes that you'll be paying. And because the employer doesn't have to pay their side of the FICA taxes, they'll understand. And a lot of times, if they're reasonable, they will agree to paying you a little bit more than they would a W-2 employee. So you have to adjust up this figure a little bit. Exactly how much? Well, we could probably eyeball it in. Let's assume that this person is single. Let's bump them up to 135,000, see what the impact is. Okay, so we're a little bit closer. We'll take another guess and put 137,000. So we're adding about $6,000 to the pay package in negotiations for the job. And that brings us much closer to what the take-home pay values would be. And depending on filing status, this will change. But I'm just looking at the single right now. If you had tax credits, that will affected. Notice the difference between hourly pay. The W-2 employee, based on 2,000 hours, is making $66 an hour, while the 1099 employee has to make about $69 or $70, assuming that they're working 2,000 hours a year. Maybe you want more than 2 weeks of vacation, so maybe for an equivalent job of this 110,000 base pay, you'd want to ask for like a $71 an hour wage. And the hourly matters because usually if you're a 1099 contractor, you're paid by the hour. Now there's one more trick that business owners or 1099 employees have up their sleeve that they could use to reduce their taxes. And that's they could write off any expense related to work. So if you're doing work for a company as a 1099 contractor, and let's say you need to buy a new mouse, or you need to build a new computer, or you need to buy a fancy microphone for conference calls or something like that, you can write that off on your taxes. And there are also other nifty deductions, such as a home office expense. You could write off the square footage of any room in your house that you use as an office. If you go to a conference related to your trade, you could write off all the expenses associated with travel to the conference and the conference fees. And you could even deduct half of the meals. So let's factor that into our spreadsheet. Let's say that this employee went to a conference during the year and maybe built a computer. And let's say that this person is really diligent about keeping receipts and is able to find $8,000 in deductions that could be written off on Schedule C. Writing off this much money lowers the base pay substantially. The employee actually earned $131,000 from the employer. That's how much they got paid. But from a tax perspective, it looks like this person only made $123,000. Okay, now to do a side-by-side comparison of an employee who didn't deduct anything versus an employee who was smart about taking deductions, and all that totaled up to $8,000. So they were able to write that off, reduce what their income is. By reducing their income for tax purposes, that reduced their FICA taxes, and it also reduced their adjusted gross income. So let's see what the impact is there. $8,000 in write-offs didn't quite get us to where the W-2 levels are, but it did make a meaningful improvement in the 1099. So that's sort of a tool that the 1099 employee could use to further reduce the taxes. And by the way, if you like the spreadsheet that I made here, you could get access to it, but you have to sign up for my Patreon. The link is below. I put a lot of work into this spreadsheet, so I'd really appreciate it if you like the spreadsheet to just buy me a cup of coffee. And I'll have a post on Patreon where you could download the Excel file for this and play around with the numbers yourself. Now, full disclosure, I'm not a tax accountant, but a long time ago I did work as a tax preparer at a retail firm. I'm actually just somebody who's worked under both tax regimes and somebody who ran the numbers because as a person working in software development, this is relevant to my business. I hope you found the information in this video to be useful, and you should definitely talk with a tax accountant to see which particular deductions apply to your individual case so that you can optimize your tax strategy. Anyway, if you like this, don't forget to hit that thumbs up button and subscribe to my channel, and I'll see you next time.